Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and those 10-year note yields. Dipped down below 220 before seeing a modest bounce back up to 225. And if you look at what happened going into the weekend, we saw yields push lower. We saw sort of the flight to quality. We saw the risk off trade, whatever you want to call it. And a lot of that was generated because of what was happening in North Korea and Syria, and it sort of created a little bit of fear. The move in yields from, say, the mid-240s down to below 230, I think, was all generated because of economics and demand, and now we're attacking on fear. And so the move we saw from 220 on the low yields overnight back up to 2.25, I think just eliminates a little bit of that as the dust has sort of settled. It hasn't gone away yet, and I still think there's another flight to quality bit out there if the North Koreans decide they're going to try and wave their saber rattling again. But at this point right now, the market is sort of calming. We did see market volatility come off today. This morning we came in, it was bid. It came off today, off those sort of very close to year-to-date highs in the 10-year. And I think that is also suggestive of the fact that we got through the weekend. The fear trade is behind us. Now we have to go back to focusing on the economic trade. And if you look ahead, and where the bond market has been doing here, it's sort of been in the wait-and-see mode. It's been tracking equities like a lot of other asset classes have been doing. You wait for equities to make a move, and then you trade. And bonds have been no different. We saw, when we saw equities sort of start to tip their hat late last week, we saw bond yields go down. We saw gold rally. We saw a lot of the flight to quality asset classes catch a bit, and we saw a lot of them soften, and bonds were no different. So I think bonds will continue to wait with stocks looking at more at earnings. We do have some data coming out. We've got obviously still the geopolitical scene is still very much unclear, and I think bonds will be very reactive here to what happens at equities, because equities are sort of steering this train, at least until we get some more in-depth numbers. And the key number, I think, is at the end of this month. We've been talking about it. It's first quarter GDP, a sub 2%, or dare I say sub 1.5%, really probably catches a bit and could see 10-year yields get pushed down probably closer to 210, if not 2%. So I think right now 10 years are going to be in very reactive mode, certainly going to remain very bullish, and you're going to continue to see yields trend lower until there's a catalyst that turns it around, and I just don't see it happening in the near term. This has been Todd Colvin coming to you from the floor of the CME Group.